when we look at what's happening, the euphoria in the equities market seems to be bringing back confidence.
Yeah.
There is
relief for you.
Relief at the moment, at least, and there is this search of what's going to happen in the real economy. There's oil and commodities.
Yeah.
The reworking of the supply and demand equation. What does all this mean for financial institutions? How do you see the banking sector playing through globally first? The re-establishing of credit markets, the availability of liquidity in global markets. When do you see that coming through, or is it already in play?
Well, I think there are many near-term challenges that still need to be taken fully on board before one gets too carried away. We are actually seeing a shift in the global financial system, because many factors led to this crisis, but within that there was a systemic failure of the financial system in the West. Now, it's not yet clear whether all the bad news is out there in the public domain. If one takes from the beginning of 2007 up to the end of the first quarter of this year, banks in the G7 had announced losses overall about $940 billion. The International Monetary Fund only this Easter was saying that maybe the banks in those same countries had losses of somewhere around $4.1 trillion. Who knows where the true figure is? Maybe it's somewhere in the middle. But one thing we do know is that there has been a substantial decline in international bank lending since last summer. The data is from the BIS, the Bank for International Settlements. From the middle of last summer to the end of last year, the latest available data, we saw $804 billion decline in international bank lending. 69% of that decline was accounted for by European banks taking their money back home. Only 12 to 13% by American banks taking their money back home. The net effect was a reduction in lending to economies across Asia, including Korea, including China, including Malaysia, including Taiwan. Also a reduction in lending to other regions of the world. Now, many of these regions are going to be able to cope with that withdrawal. And also it should be stressed not all banks are withdrawing their lending. Standard Chartered is actually continuing to lend aggressively and do more in this crisis. But what one sees is that problems in Central and Eastern Europe are spreading contagion-wise into Western Europe. On top of that, Western Europe has a deep economic adjustment underway. So Western European banks are taking their money back home. Of course, on top of all this, in many countries, governments have used taxpayers' money to help out the financial sector. And even though those governments are not protectionist, they naturally want those banks to actually do more at home than overseas. So we have to be very acutely aware of the near-term challenges in some of these areas, such as international bank lending.
Okay, there is a fall in global credit. And how's that juxtaposed to the demand for US dollars?
Yeah, I would take those two issues separately. In terms of financial markets recently, we've started to see not yet a normalisation, but a return towards normalisation. Initially, it was good quality credits were able to raise funds. Now we've seen that spread to higher yielding corporates able to access funds. We've also started to see more money going into emerging markets. We've seen CDS spreads come in. Take, for instance, China's CDS spread. Right. That's now back to where it was at pre-Lehman's levels, 72 basis points. But in normal times, it's about 30 to 40 basis points. So we're seeing things come back towards normal, but they haven't yet reached normal. But high-yielding names are now able to raise funds and access the credit market. So that's good. In terms of the dollar, the interesting thing about the dollar is during this crisis, it was easy to turn on the radio, read your magazine and hear and read so many people saying negative things about the dollar. And what happened? The dollar benefited. In the crisis, people looked for the safety of the dollar. The dollar thrives on misery and it's likely to weaken in prosperity. Basically, in the crisis, people wanted the depth and the liquidity of US financial markets and they trusted the dollar. As we start to come out of this recession into recovery, I think it's likely that the dollar will weaken against Asian currencies, weaken more generally. The euro might not strengthen too much because of problems in Europe I touched on. As we move into the medium longer term, some of the issues raised by the Chinese in particular ahead of the G20 meeting will come to the fore. Is there an alternative to the US dollar as the world's major currency? Once upon a time, not too long ago, Britain was the world's most important economy. And long after Britain ceased to be the most important economy, sterling still was the most important currency. So even though there is a fundamental shift in the world economy underway, even though there are many problems for the US, for a currency to lose its reserve currency status does take some time. I think the dollar does face big challenges, but I think of it more as a sort of slow burning fuse underneath the dollar.
But several things ought to happen in order for the dollar to lose its reserve status. Firstly, the cost of funds and domestic funding and versus international funding. A number of emerging markets are becoming able to raise funds domestically. China being the most prominent among them. There's also the Japanese yen, which really was funding the carry trade in a lot of emerging markets, basically. So that's a distortion on the impact of the dollar.
Well, it's quite interesting that the US dollar itself could well be the funding currency if, as seems likely, US rates have to remain low for a considerable period of time.
Right.
But on top of that, I think there are some important issues. The medium of exchange and the store of value concepts are always important. Recently, we saw the Chinese and Brazilians agree to pay each other not in dollars, as was the norm, but in their own currencies, which is a fundamental shift. And then the whole store of value issue. What will be the consequence of all this policy easing in the States? I personally think that people worry too much about the inflation implications of monetary policy easing. I think the Fed, and not just the Fed, the Bank of England and central banks in other countries have done an absolutely fantastic job. I have no confidence that these central banks will be able to take liquidity out of the system when they need to. My fear is that some people might force them, the markets that is, might force them to try and take that liquidity out sooner rather than later. I hope that the central banks have the strength to continue to keep policy lax and to continue to keep liquidity in the markets.